Look, I want you to picture this. You started a business 2 years ago. You've poured $50,000 of your own savings into it. You've worked nights, weekends. You haven't taken a vacation in 18 months. And here's the thing. It's failing. Sales are flat. You hate the product, and you're miserable. Now, a smart new opportunity just landed in your lap, something you genuinely love with low startup cost. Any rational person would cut bait and jump ship, right? But you don't. You keep pushing the rock up the hill. You tell yourself, I can't quit now. I've already put in $50,000 in 2 years. That would all be wasted. That feeling, that desperate refusal to quit a sinking ship because of the money and time you've already spent, that's not dedication. That's not grit. That is the sunk cost fallacy, and it is quietly the single most destructive psychological trap in your entire financial life. It costs you more money than taxes, inflation, and bad investment decisions combined. But that's just the appetizer. Today, we're also tackling its evil twin, the anchor bias, the single number that is secretly hijacking every negotiation, every purchasing decision, and even your salary review. My name is John, and I spend way too much time thinking about the psychology of money. I'm obsessed with the invisible mental traps that keep good people broke. If you're someone who feels like you're doing all the right things, saving, investing, but still hitting a financial ceiling, or just can't seem to quit that bad habit, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Let's talk about how to stop chasing bad money with good money. Here's what most people don't realize. When you make a financial decision, whether to keep funding that project, hold that stock, or pay for that membership, your past money is irrelevant. It's gone. It is a sunk cost. You can never get it back. The only thing that matters is the marginal cost, the cost of the next decision you make, starting right now. The math and the mistake. Nick, let's use a shocking statistic. A famous study by the National Bureau of Economic Research found that people who purchased season tickets to a theater who had a sunk cost attended more shows than people who won tickets for free. Why? Because the ticket buyers felt they had to justify the money they already spent, even if they were tired or didn't like the show. They made themselves miserable to satisfy the sunk cost god. This isn't just about tickets. It's about bad investments. Example, you bought 1,000 shares of XYZ stock at $50 per share. You put in $50,000. The stock has since fallen to $10 per share. Your investment is now worth only $10,000. You have a $40,000 paper loss. Now, you have two choices. Sell it. Take the $10,000 and put it into a new investment that you believe will double. Hold it. Wait for XYZ to come back. Nick, here's the trap. You look at that $40,000 and feel a physical need to get it back. You hold on to the stock, which continues to bleed value, ignoring the fact that the original $50,000 is irrelevant to the future performance of the stock. You are confusing hope with a sound financial strategy. The correct decision is to look at the stock and ask, if I had $10,000 cash right now, would I buy this stock? If the answer is no, you sell. Period. You are not losing $40,000. You already lost it. You are saving the remaining $10,000. The psychology. Avoiding personal failure. Nick, this is where it gets really interesting. The sunk cost fallacy isn't about the money. It's about ego. We cling to failing ventures because admitting the loss is admitting we were wrong. It's admitting that the 2 years of effort The late nights, the stress, was all a mistake, and our brains are wired to avoid that pain. Analogy. Think of it like cooking a terrible dinner. You bought all the expensive ingredients, you spent 3 hours making it, and it tastes awful. Do you force yourself, your family, and your guests to eat it just because you spent $75 on ingredients? No. You throw it out, cut the losses, and order a pizza. The $75 is gone either way, but eating the bad food makes you more miserable. Actionable trick. The clean slate test. Nick, here's your actionable trick to stop the sunk cost fallacy. Write down the sunk cost. Write down the $50,000 you spent on the business or the $40,000 you lost in the stock. Cross it out. That money never existed. It's a memory. Perform the clean slate test. Ask yourself, if I woke up today and had $0 invested in this, would I put my first dollar into it right now? If the answer is still no, you've won. You've used psychology to beat a psychological trap. You've freed your capital to chase better, more profitable opportunities. Now, let's pivot to the second, equally destructive bias that costs you money. Anchor bias. This is why you have to negotiate your salary, your car price, and even your mortgage rate. Because the very first number mentioned in any discussion, the anchor, becomes the gravitational center of all future negotiations, even if that number is completely ridiculous. The shocking statistics, Nick. Look at this statistic. In a study, real estate agents were asked to estimate the value of a house. But first, they were given a fake asking price, the anchor. When the anchor was high, the agent's final estimates were 12% higher. When the anchor was low, their estimates were 12% lower. Get this. These were professional negotiators and agents, and they couldn't ignore the anchor. If they can't ignore it, what chance do you have? The salary trap, Nick. This is where the anchor bias costs you tens of thousands of dollars over your lifetime. Salary negotiation. When a hiring manager asks you, "What are you currently making?" and you respond with $75,000, that is your anchor. The vast majority of offers will now cluster just above that, maybe at $78,000 or $80,000. Now you might be thinking, well, I can't lie about my current salary. You don't have to lie. You simply refuse to let their question become the anchor. Here's the powerful shift. Instead of letting your current low salary be the anchor, you must introduce your target salary as the first number. If they say, "What are you making?" you respond with, "Based on my research into industry standards and the value I'll bring to this specific role, I'm targeting a base compensation in the range of $95,000 to $105,000. You have instantly psychologically increased your negotiating floor by $15,000. That's the power of setting the anchor. How to master the anchor. Nick, there are two ways to use the anchor bias to your advantage. The high ridiculous anchor, the opening move. Nick, when selling a used car or negotiating a consulting fee, always start high. Sometimes a little ridiculously high. If your car is realistically worth $15,000, you list it for $17,500. Why? Because when the buyer walks in, that $17,500 number is the anchor. Even if you end up settling at $16,000, the buyer feels like they won, and you've made $1,000 more than you expected. You use the anchor to create a perceived deal for the other side. The precision anchor. The power move. Nick, here's a subtle but powerful psychological trick from academic research. Instead of setting an anchor at a round number, set it at a precise odd number. Instead of saying, "My consulting fee is $100 per hour," say, "My consulting fee is $103.50 per hour." The precise number, $103.50, suggests you have done serious, detailed research to arrive at that specific figure. It makes the anchor feel non-negotiable and based on a complex calculation, not just a guess. It is a much stronger anchor. Part 4. Conclusion and Action Plan. So, what did we learn today? We learned that you are not a purely rational economic machine. You are a human being prone to powerful, invisible psychological biases. The goal isn't to eliminate these biases. That's impossible. The goal is to recognize them and use specific systems to bypass them. Your action plan for financial freedom. Stop feeding the dead horse, sunk cost. Go through your investments, your subscriptions, and your time commitments. For every single one, apply the clean slate test. If you wouldn't start it today, cut it. Your freedom is more valuable than your ego. Anchor up your value. The next time you enter any negotiation, salary, purchase, or service contract, you must be the one to introduce the first number. Base your anchor, not on what you currently have, but on what you deserve and what the market will bear. And be precise. This isn't about being manipulative. It's about being prepared. It's about playing the game by the rules of psychology, not just the rules of math. Because the math tells you what to do, but the psychology is what actually gets you to do it. Nick, if you like this breakdown of the invisible psychological forces controlling your wealth, hit that like button. Let me know in the comments below. What is the biggest sunk cost you are struggling to let go of right now? Your answer might help someone else. If you want to dive deeper into the systems that automate your financial decisions so you don't even have to think about the money, watch this video right here on the Reverse Budget. Thanks for watching, and I'll see you in the next one. Stop giving away your money to invisible traps. Now, we talked about sunk costs, money you've lost. But what about money you technically have? Why is it so incredibly hard to sell something you own, even if you know you could get a good price for it? This brings us to the third mental trap, the endowment effect. Here's the simple definition. We place a higher value on things we own than on things we don't. Once something is in our hands, whether it's a stock, a piece of real estate, or just an old guitar, the simple fact of ownership inflates its perceived worth. The psychology of ownership, Nick, the Nobel Prize-winning economist Richard Thaler, demonstrated this perfectly with a simple experiment using coffee mugs. He gave one group of students a mug and asked them how much they would sell it for. He asked another group of students how much they would buy that exact same mug for. The result was staggering. The students who owned the mug demanded a price twice as high as the price the buyers were willing to pay. Twice as high. They didn't pay for the mug. They were simply endowed with it. But their brains instantly registered selling it as a loss, and humans are fundamentally loss-averse. The real estate and stock killer, Nick. This is devastating for your financial portfolio and your real estate deals. Real estate. You renovate your kitchen, you love it. You decide to sell the house. You tack on an extra $30,000 to the asking price because you feel your custom tile work is priceless. The market looks at it and says, it's a kitchen. We value it at $10,000. Your emotional attachment, the endowment effect, costs you the sale, forcing you to sit on the house for months, costing you interest and stress. Stocks. You bought a solid company 5 years ago. It's done great. Now it's plateauing, and there are 3 hotter investments begging for your capital. You refuse to sell because you feel loyal to the stock you chose. It was your smart investment. You overvalue it simply because it's yours, and you miss out on massive future gains. The solution is the same as sunk cost. Decouple the asset from your identity. You must view the asset not as my stock, but as an investment opportunity that happens to be sitting in my brokerage account. Okay, we've tackled sunk costs, the money you lost. We've talked about endowment, the things you own. Now let's talk about the money you have and why you treat $1 differently than the next, even though they all spend the same. This is the sneaky, insidious trap called mental accounting. Here's what most people don't realize. When you get a tax refund, a work bonus, or win $500 at the casino, you don't treat that money like the $500 you earned working 40 hours last week. You are compartmentalizing your money into arbitrary mental buckets, and those buckets have irrational rules. The psychology. Money has feelings. Nick, you might see the $500 tax refund as found money, which your brain registers as separate from your serious salary money. Because it's found, you give yourself permission to blow it on a frivolous purchase, a new gadget, or an expensive dinner. But when you calculate your net worth, you realize that $500 should have gone into your retirement account, compounding for the next 30 years. You sacrifice guaranteed future wealth for instant gratification simply because of the source of the money. Analogy. Imagine you accidentally leave a $20 bill in your old jacket pocket. You find it weeks later. Do you put it toward your mortgage? No. You think, hey, lunch is on me. That $20 is psychologically tagged as freebie lunch money, not debt reduction money. This is mental accounting in action, the debt consolidation killer, Nick. This is where it gets really destructive. We often talk about consolidating high-interest debt. Let's say you have 3 debts. Credit card 1, $5,000 at 25% APR credit card. 2, $5,000 at 18%. APR personal loan, $5,000 at 10% APR. Mathematically, you always attack the 25% APR debt first, the avalanche method. But the mental accountant in your head says, I hate that little 10% loan. It feels like it's been around forever. I need to pay that one off first so I can feel like I've finished something. You attack the easiest or oldest debt, wasting thousands of dollars in high-interest payments because you prioritize the feeling of closure over the mathematical efficiency. Actionable trick. The single pot. Rule. Nick, the fix is simple but requires iron discipline. You must adopt the single pot rule. All your money is fungible. $1 earned from your salary is worth exactly the same as $1 won in the lottery or $1 found in the street. Combine your view. When you get a bonus, don't ask, what should I splurge on? Ask, where, mathematically, does this money do the most good? Prioritize by math, not emotion. Pay off the highest interest rate first, regardless of the debt name or the story you associate with it. We've now covered sunk costs, endowment, and mental accounting. They seem like 3 separate problems, but they all share one emotional core that is secretly steering your financial life: regret aversion. We are desperately trying to avoid feeling the pain of "I should have." Sunk cost. You hold the losing stock because you are terrified of selling it, only to see it rebound. The regret of selling too early is worse than the regret of riding it to zero. Endowment effect. You overprice your house and wait 2 extra months for a sale because the thought of selling it quickly and realizing later you could have gotten more money feels like a profound mistake. Mental accounting. You buy the lottery ticket or splurge on the freebie money because the regret of missing out on the spontaneous fun feels worse than the regret of missing future compounding interest. The decision matrix trap. Nick, this trap paralyzes your ability to take calculated risk, which is the engine of wealth. When you look at a decision, your brain doesn't just calculate the expected value of success, it calculates the maximum potential for future regret. And if that maximum regret is high, you choose the safest, most passive option, which often means doing nothing, holding the bad stock, sitting on the overpriced house. Actionable trick. The pre-mortem. Nick, before you make a critical financial decision, do a pre-mortem. Assume the worst. Imagine it's 1 year later and your decision was a total disaster. Write down the reasons why it failed. Did the market crash? Did the investment dry up? Ask, did I make the best decision with the information I had at the time? If the answer is yes, then the failure is a market event, not a personal failure. You prepared for it. This simple exercise removes the shame and fear, giving you the clarity to act decisively. Final conclusion and action plan. 12 o'clock to end. Visual. Transition back to Nick in front of the whiteboard, focusing on the 3 main headings. Nick. Final summary of sunk cost, endowment, and mental accounting. You are not fighting market volatility. You are not fighting inflation. You are fighting the 6 inches between your ears. Your financial life is determined by your ability to separate emotion from math. Your complete action plan for financial freedom, sunk cost. Ego killer. Use the clean slate test today. Look at every losing commitment and ask if you would start it from scratch. If not, cut it immediately. Endowment. Possession killer. Use the market value test. Look at any asset you own and ask, if I didn't own this, would I pay the current asking price to acquire it? If the answer is no, you are overvaluing it. Mental accounting. Efficiency killer. Use the single pot rule. All money is fungible. Prioritize all spending and debt payoff based only on the highest potential return or highest interest rate. Regret aversion. Action killer. Use the pre-mortem. Analyze the worst-case scenario before you act. This removes the fear of future regret and empowers you to make calculated decisions. You have the math. You have the psychology. Now you have the advantage.